Advanced Accounting, Part 12, Number 12, Part 4, two topics here, amortizing goodwill and dealing again with intercompany gross profit. So I have two problems I'm going to discuss here that I was sent recently by a student. On January 3rd, Austin Apparent purchases 25% of the voting common stock of a sub Gainesville, and they pay $2.5 million. Austin decides to use the equity method to account for this investment. If you look at video Advanced 12 Part 3, you'll see a definition of the equity method. They give you Gaines stockholders' equity on the date of the purchase, which was $8 million, and they say that's the same as the book value. So normally, if they change terms for the same thing, net assets, book value, equity all mean the same thing normally for these types of consolidation problems. You're given information on assets versus liabilities, and you see that book values differ from fair values for some of these assets. They go on to say for all other assets and liabilities, the book value and the fair value were equal. So what do we do if we pay more than the fair value? Well, we attribute that to goodwill, and they tell you that goodwill is not impaired. Question: what's the total amount of the excess amortization of the goodwill? You have to infer here a couple things. When they say excess amortization, they're talking about amortizing a couple of things. If you go down here, you'll see off to the right, I'm going to comment on amortizing here in just a second. Now, another thing I had to make is they said for 2011, they didn't say 12 for the whole year. They didn't say 12/31/2011. So I had to assume that they meant to say 1 year of amortization has occurred the entire year of 2011. So now, I took the fair values in the right column less the book value in the left and came up with these differences. For example, 500,000 minus 400. There's my fair market value in excess of book value for these assets. You'll see that there is an intangible asset called franchise that had no book value. But when we buy the company, we add an intangible asset franchise to the books and we say it's worth 400,000. So that's a $400,000 increase. Now, 1 year of amortization, assuming that each of these assets are valued at different useful lives, so the building's valued at a 10-year useful life divided by 10, the equipment 5, etc. The franchise 8 years, so there's 1 year of amortization for the whole company. All the assets that had a fair market value in excess. Now, we have to do a couple things because not only do we have to deal with fair value greater than book value, we also have to deal with that goodwill, if any, was created. So, since Gainesville, what's Gainesville, the sub's true value, assuming that the parent paid $2.5 million for 25% of the value of the company? That implies that if I take cost in blue divided by percent purchased in green, the value of the whole entity, the sub, is $10 million. So if the fair value in total is $10 million, and the book value that I'm giving the question is worth $8 million, again, book value, equity, net assets, they may use the terms interchangeably. The entire differential is $2 million, the difference between fair value of the consideration in blue and the book value in green. So I have the differential here, and I want to calculate, how do I assign that differential? Well, the fair market value of the assets in excess of book value, we find out, is $800,000, excuse me. That accounts for $800,000 of the differential. That means that the remaining differential is assigned to book value, assigned to goodwill, $1.2 million. And we know that Austin's share of the goodwill is 25% in green times the goodwill in blue of 1.2 million. So Austin's share of the goodwill is 300,000. Finally, if you want to figure out the excess Austin share, the parent of the excess amortization, we saw amortization annually, X that out. We saw amortization annually for the franchise of $50,000 a year. I'm going to correct that number because that's the total value of the asset. So the amortization each year is 50. Austin owns 25% of the total, so Austin's share of the excess amortization would be $12,500. So that answers our excess amortization for Austin for 1 year. Let me jump over to this intercompany gross profit. I'm going to do it quickly, but there's a method of calculating when one entity sells goods to another and you're consolidating. How do I calculate intercompany profit? You're given in the question up here, I'll do it down here. The first step, and it doesn't matter if it's upstream sub selling to parent or downstream parent selling to sub, you eliminate it in the same fashion. You calculate the beginning and the ending inventory for the person who buys the inventory, whether it's the parent or the sub. So we're told in the question that of $48,000 purchased in the prior year, 25% of it is still on the books at the beginning of 2011. So 48,000 times 25% is 12. At the end of the year, of $60,000 purchased from the intercompany, the other side, 40% remains on the books at the end of the year. We're looking at 2011. So if I take 60,000 times 40, I get my ending inventory. The next step is I've got to calculate the gross profit that's in these beginning and inventory and ending inventory numbers. So the way to do it is to take the price at which it was sold to the parent, the cost to the seller, take that difference and come up with a gross profit percentage. So it's sale price less cost divided by cost to get the markup, about 67% beginning inventory, about 79% ending. And then I'm multiplying the inventory amounts I found in step 1, blue, by the gross profit percentage in green to come up with the gross profit that's in that inventory, both beginning and ending. So we have an elimination entry for the buyer. Inventory is overstated because they have it on their books at an inflated price. For the seller, the gross profit's overstated. So in consolidation, we need to debit to reduce net income. We need to credit to reduce inventory. At large, the buyer's share of that income is 30%. So 30% of this journal entry is going to go toward income that's overstated. So to finish this up, here's the investment in ticker account that at large the parent has on the books. Here's the purchase price, 402. Here's their share of the income. The parent's share of the sub's income, 32,400. Here's amortization of the goodwill. Here's the parent's at large's share of ticker's dividend, which reduces the investment account. And then finally, there's that overstated income that we saw just above. So the 30% of the total intercompany profit, that number in blue, gets eliminated. It reduces the investment in ticker asset account. And so we can calculate a new investment balance, the debits in blue less the credits in green. Wanted to mention that on the website, stltest.net, in addition to tutoring services, we now have our video accounting textbooks, which are video instruction using Excel. And if you go to my site and click on this page, it takes you to a page where you can buy the 3-hour and 3-minute course for accounting for investments online. Explains the course, gives you a video link that explains how the course works that's on a YouTube channel. Thanks very much, and we'll see you